Hi, I'm Pattu from freefincal. So you must have heard people from mutual fund AMCs or their sales guys says that don't stop your SIPs, stay invested, have patience. The stock market always moves up in the long term. That's technically true, but that's not practically of use to anybody because the stock market may move up in the long term, but the returns, the associated returns, which is what we are going to get, will move up and down. It will fluctuate. Nobody cares whether the Sensex is 60,000 or 600,000. What matters is how much return we got. So if you look at the Sensex from April 1979, it looks like that. I mean, it looks, oh, look at that. It keeps moving. Yeah, there may be some fall here and there, some sideways market here and there. One fall here, one fall here, one fall here. But look, it has always moved up. No, that means if you keep invested, you will make money. That's not really true. Let's take rolling returns. SIP. Let's take SIP rolling returns. Before we do that, this is the Sensex in the log scale, and I have a video called the Sensex staircase. Are you ready to climb the Sensex staircase? You can search for that if you want to know more about what the log scale is and how it's going to be of use to you. Now, what I've done is, suppose you start an SIP in April 1979. After 15 years, in April 1994, the returns before dividends would be 28.4%. If you add dividends, in those days dividends may not be too much, 1% you can add for dividends. Today dividends are a little bit more. You can add 1.5 to 2% over the long term. Now what I've done is this 15-year window, I have shifted it by one month. So from April 1979 starting date, you shift it by 1 month to May 1979, the return is 28%. From May 1979 to June 1979, if you shift it by 1 month, the window itself is shifted, it's you'll get some other value. If you shift it by 1 month, again you'll get some other value, and so on. And you get about 329 15-year data points. SIP returns. These are only 329 because the history is too short. Now if you look at this, you can say that, if I look at this, I can say the returns have been falling down, and it has fallen down all the way. There's an all-time low somewhere near in the 2002 and so on, just before the big bull run, and then it moved up, then it fell down, moved up, fluctuated, fell down, all the way almost to the all-time low of in March 2020, and then it moved up. So you can see it moves up and down. Just because the stock market moves up and down doesn't mean your return is also going to be steady or it's going to move all the time. It's going to increase. Then if you look at this, actually, if you see returns have actually come down over time. So this is the most important point you should understand about risk. If you just put your money into SIP and say SIP will make you disciplined, if you listen to these people on Twitter, they will say SIP will make you disciplined, SIP is systematic investing and so on. All you are doing is, if you don't have any other plan, if you don't have any asset allocation, if you don't have any proper goal in mind, all you are doing is leaving the fate of your investments to luck. Even if we don't deserve respect, our money deserves more respect. So we have to take care of our money, manage the risk. SIP is not systematic investing. SIP is just automated investing. Systematic investing means having a proper system and then investing. And that's not what SIP is. It's got nothing to do with what an SIP is. So SIP is just buying units on the same day of each month. Now, if you look at the S&P 500, the cyclic nature of these returns becomes even more dramatic. This is from 1900. You can see, I would say, that's a nice straight line right there. You hear little bit here and there, but then it keeps moving up. And if you look at it at a normal scale, it looks extraordinarily bizarre. Just from 1980 to 1900, it looks flat here, and then from there it just zoomed all the way up. And if you look at the returns though, look at the returns there. Those are 1333 points. Each one of these are 15-year data points, and this is in, of course, USD. The returns are in USD. It goes up, down, up, down, up, down, up, and so on. So stock market may move up, but returns will move up and down. The reason for this is because of time. See, from March 2020 to March 2021, the Sensex or the Nifty moved up by 92 or 95% or something like that. That move was a big move. 90% return between March 2020 and 2021. Sometimes that 90% return can come in 1 year, like we saw. That 90% return can take 5 years. It can take 10 years. And so So that's why I keep talking about sideways market. So what happens is a sideways market can destroy the gains. This 90% 1 year return, if the Sensex is flat for the next 2-3 years, then over 5 years, if you look at it, all those, that 90% gain would have evaporated slowly. So time will evaporate those returns, and that's basically the reason why the returns keep moving up and down. The long term Sensex can keep going up, but because of the time involved, the time taken to move up by 20% or 30% or 90% is different every time, and because of that you get different returns for your money. So the only way we can safeguard our money and not just leave it to luck is to have a proper goal, have a proper asset allocation for that goal, and continuously systematically manage risk in that portfolio by varying the asset allocation, so that your target corpus, you have a clear idea of what your target corpus is, and your actual corpus is close to the target corpus. This is something that I've said again and again and again in previous videos, and it's so important that it doesn't matter if I say it one more time.